What are hybrid funds? Before we get into aggressive hybrid funds, let's understand hybrid funds in general. Hybrid funds are mutual funds that invest in a mix of stocks and debt instruments. Stocks give you the growth potential, while debt gives some stability and regular income. Think of it like a balanced diet. Too much sugar can be risky, but a mix of protein and carbs keeps things stable. Similarly, hybrid funds balance risk and growth. Aggressive hybrid funds explained. Now, what makes a hybrid fund aggressive? An aggressive hybrid fund invests mostly in equities, usually 65% to 80% in stocks, and the rest in debt or fixed income instruments. Why aggressive? Because your money has a higher chance to grow faster than a regular hybrid fund, but there's also more exposure to stock market ups and downs. It's a good choice for investors who want growth, but also some protection against risk. How they work. Here's how aggressive hybrid funds work in practice. The equity portion is invested in stocks of companies, sometimes large cap, sometimes mid cap. The debt portion is invested in bonds, government securities, or corporate deposits. The fund manager decides which stocks or bonds to buy based on research and market conditions. So, as an investor, you don't have to pick individual stocks or bonds. The fund does that for you. Benefits of aggressive hybrid funds. Why should you consider aggressive hybrid funds? Potential for higher returns than pure debt or balanced funds. Moderate risk compared to pure equity funds. Professional management. Fund managers decide the mix of equity and debt. Tax efficiency. In India, these are treated like equity funds for long-term capital gains. In short, you get growth, some safety, and professional management in one fund. Examples of popular aggressive hybrid funds. Let's look at a few examples of popular aggressive hybrid funds. UTI Aggressive Hybrid Fund focuses on long-term growth with a mix of equity and debt. Sundaram Aggressive Hybrid Fund aims to balance growth with stability. JM Aggressive Hybrid Fund, known for strong historical returns. These funds have been chosen based on past performance, but remember, past returns don't guarantee future results. Understanding equity portion. The key to growth in aggressive hybrid funds is the equity portion. This part is invested in the stock market. It could be in large cap companies for stability or mid cap and small cap for higher growth. The equity allocation is fixed or slightly flexible, depending on the fund. The equity portion is why these funds are called aggressive. It drives higher returns over time. Understanding debt portion. Next is the debt portion. It's usually 20 to 35% of the fund, invested in bonds, government securities, or corporate debt. This part reduces volatility when the stock market falls. Think of it as a safety net. It won't make huge returns, but it prevents your portfolio from dropping too much during a market crash. Aggressive hybrid versus balanced advantage funds. Many people ask, what's the difference between an aggressive hybrid fund and a balanced advantage fund? Aggressive hybrid fund. Fixed allocation, 70% equity, 30% debt, roughly. Balanced advantage fund. Dynamic allocation. The fund can shift more into equity or debt depending on the market. So if you want predictable allocation, go aggressive hybrid. If you want the fund to adjust to market conditions, balanced advantage might be better. Who should invest? Who should invest in aggressive hybrid funds? Investors who want equity growth, but with some cushion from debt. People with medium to long-term goals, ideally 5 years or more. Investors with moderate to high-risk tolerance. These funds are not for someone looking for short-term safety or guaranteed returns. If that's your goal, a pure debt fund is better. Risk factors. It's important to understand the risks. Market risk. Equity prices can fall, reducing returns. Interest rate risk. Debt portion can lose value if interest rates rise. Manager risk. Returns depend on the fund manager's decisions. So, while aggressive hybrid funds are safer than pure equity funds, they still carry risk. Always invest only what you can afford to leave for the medium to long term. How to choose a fund. When choosing an aggressive hybrid fund, consider historical performance. Check 3-year and 5-year returns. Expense ratio. Lower is better for long-term growth. Fund manager experience. A skilled manager can make a big difference. Consistency. Look for funds that perform steadily, not just in 1 year. Also, compare funds using platforms like Value Research Online or Scriptbox for ratings and returns. Tax implications. Tax-wise, aggressive hybrid funds are treated like equity funds in India. Long-term capital gains, LTCG, 10% if held over 12 months, exceeding Rs 1 lakh in gains. Short-term capital gains, STCG, 15% if sold before 12 months. This is better than debt funds for long-term investing because the equity tax treatment can save you money over time. Real-life example. Let's take a real-life example. Suppose you invest Rs 1 lakh in JM Aggressive Hybrid Fund. The equity portion is invested in stocks and the debt portion in bonds. Over 5 years, assuming an average annual return of 1215%, your Rs 1 lakh could grow to around Rs 1.8 to 2 lakh. Compare that to a regular debt fund that might give 6 to 7% annual returns. The aggressive hybrid fund nearly doubles your money in the same period, while still being safer than a 100% equity fund. Tips for investors. Here are some tips if you're investing in aggressive hybrid funds. Invest for the long term, at least 5 years. SEP, Systematic Investment Plan, is better than lump sum to reduce risk. Diversify. Don't put all your money in one fund. Review regularly. Check performance once a year. Remember, consistency matters more than timing the market. So that's your complete guide to aggressive hybrid funds. They are equity-heavy but partially safe. Examples include UTI, Sundaram, JM Aggressive Hybrid Funds. Best for medium to long-term investors with moderate risk tolerance. If you found this video helpful, hit the like button, subscribe, and comment below which fund you're thinking of investing in. I'll help break it down for you. Thanks for watching, and see you in the next video.